Hey guys, welcome back to XRP and beyond. In this video, there isn't going to be much fundamental news or anything new happening in the market, but I just wanted to talk about a couple of things, uh, specifically trading versus investing. But before that, I wanted to talk about the AMM pools on XRP, and I'm still here on Orchestra.finance, just looking at the pools, and as you can see, the XRP and USDC pair is not the highest liquidity one anymore. It's now XRP and Sologenic, which is interesting. Um, Obviously, this could still change a lot, and it's still very early. Um, so we'll keep up with this and see how things develop. But yeah, let me move on to the next thing here. So yeah, the the reason why I wanted to talk about trading versus investing is because I've been seeing a lot of talks about, um, with the recent pullback that we had, people are fearful, obviously, right? And some people are saying we're going lower. I don't know if we're going lower. Nobody technically does, right? Nobody knows. Um, and so I wanted to talk about like a concept of risk versus reward. And when it comes to trading, it's like the most important thing, right? And so there's like certain ways you manage that risk, and it's about getting in at the right time and protecting um certain levels of support. And if it breaks that support, then you trigger your stop loss, so that you lose less if you're wrong, but you gain a lot if you're right, right? So that's basically the idea that you want to set up for trading. Now, with investing, I wouldn't say there's a right way of doing it, because there's many ways that works. Um, but the one that I use is just dollar cost averaging. Um, and I also kind of mix in some just big purchases during like capitulation events, right? Kind of like what we had. Um, and the idea there is just to get a solid position in whatever you're investing in, right? And if you just keep doing that at an average rate, then you're going to be buying both tops and bottoms, right? Um, that's why it's called dollar cost averaging, right? You're getting an average price there. But then once price starts rising and it goes past all-time highs, then you're just in pure profit, and you could do more stuff with your money from there. But um yeah, the idea is just building up your position for the long term. Some people don't even sell, right? Because you could totally just save in something that you're fully confident in, something like gold, for example, right? And then just have it there for life, basically, or just treat it like a 401k, like you would treat a 401k, right? Um, Usually people that have 401ks, they wouldn't just pull money out if there's dips or anything like that. Um, they would just stick with it, right? Just constantly growing it. That's the exact same idea. You're just dollar cost averaging. Um, I do see a lot of people trying to time markets, and I don't know if you guys have ever heard the phrase. Um, Geez, what was it? Time in the markets beats timing the markets, and it's so true, because I mean it's self-explanatory, but if you really want me to explain it, then yeah, you're just gonna beat everyone who's impatient, which is most people, and those who are trying to time it are often going to be wrong, because those people that try to time it, usually they're just trading based off of emotions. And, well, we already know that emotions in the market are not, they're like the opposite of where the market will be going most of the time, right? If you're fearful, that's usually a good time to be in, but people just think about it in the opposite way, in the way that they're used to, right? If you're fearful, you have an emotional reaction to that, and that could make you make a decision, which could be sell, and usually that's a mistake. And nothing, as you guys know, is investment advice in this video or anything. I'm just talking with what I've seen that happens a lot. I mean, this is just my experience, right? But also it's data. You can look at it yourself. I would encourage you guys to look at examples of this. I mean, it works everywhere. It's not just in crypto, right? This works in the stock market, in the house market, but the differences would be the volatility, because some of these assets have way more liquidity, and then so it takes way more money to move them and stuff. But yeah, I just wanted to get those concepts out there so that people could start thinking a little bit more about making just wise decisions, because I see people just lose so many fortunes on Twitter, and it's a shame. I mean, not everyone can be a winner, obviously, right? But for those people that are trying to learn from their mistakes and stuff, I mean, I myself have made those mistakes, right? When I first jumped into crypto in 2017, I jumped in right at the top. I was part of that hype wave that came in at the top. I was hearing it from people. I was like, wow, this is crazy. I mean, how I didn't know what was going to happen, so I didn't invest much back then, which thank God, right? Bitcoin was like $17,000 at the time. And yeah, I mean, I just experienced the top. I experienced what the bottom felt like. I experienced what the boredom felt like, the COVID crash, the euphoria again with Bitcoin. And then we're here again, a new all-time high. It's crazy. And, I just, after seeing everything that happened with Bitcoin, and it doesn't even have a real use case aside from store of value, how could XRP not be worth more in terms of market cap, right? One day. I'm not saying right now, whatever, right? But yeah, I guess I can end the video there. I just wanted to flesh out some ideas to help some people out here. But yeah, guys, let me know what you guys think in the comments. I would like to know what your guys' strategies are. Or if you have anything for anyone to share, helping them on their journey. But yeah, I'll probably talk to you guys tomorrow. So I'll see you guys in the next video. See ya.